Right now, somewhere in Ontario, a family is packing boxes. They are not moving across town. They are moving across the border. And they are not alone. In the first quarter of 2026, Canada recorded its sharpest population outflow in over a decade. Tens of thousands of skilled professionals, young families and retirees heading south, east, anywhere the math still works. But here's the part nobody in Washington is paying attention to. Every single one of those departures is a lit fuse running straight toward the American housing market. This is not a story about Canadian immigration policy. This is a story about how one country's economic collapse is about to trigger a cascade that reprices American real estate from coast to coast. Because the United States housing market in 2026 is not struggling with one crisis. It is being strangled by 6 of them simultaneously, and Canada just added the 7th. To understand the scale of what is coming, you need one number: $150,000. That is the household income now required to live what previous generations would have called an ordinary middle-class life in America. Not wealthy, not comfortable, ordinary. 2 bedrooms, reliable transportation, health insurance that actually functions, and enough left over to put something into retirement. $150,000. The median American household earns roughly half that, which means the majority of this country has been priced out of the life they were promised. Not by bad luck, not by poor choices, but by a system that has systematically converted their labor into someone else's portfolio returns. The median home now costs over $450,000. At current mortgage rates, the monthly payment, with taxes and insurance, approaches $4,000. A family earning the national median would surrender 60% of their gross income just for shelter. That is not financial strain. That is mathematical impossibility. And it explains why an entire generation has been converted from homeowners into permanent tenants, paying rent to institutional landlords who bought the houses they were supposed to own. But the housing crisis you have heard about, the rates, the prices, the inventory, that is the visible wound. What is quietly destroying the market from the inside is something far more dangerous, something most analysts are still ignoring. And when Canada's economic refugees begin arriving in American cities, competing for the same shrinking housing stock, the pressure cooker that is already at capacity will have nowhere to release. To understand why this moment is different from every correction that came before, we need to look at the foundation, at the machinery that was built, brick by brick, over the last 40 years. The architecture of the current crisis was not designed in a single moment. It was assembled across decades through a series of decisions that each seemed rational in isolation, but together created a trap with no obvious exit. Start with the most fundamental shift, the conversion of the American home from a wealth-building tool into a financial instrument. For most of the 20th century, a house was a forced savings vehicle. You paid a mortgage for 30 years and emerged with an asset that funded your retirement. That model assumed one critical condition: that housing remained accessible to working families. That condition no longer holds. Institutional capital discovered residential real estate in the aftermath of the 2008 crash. Firms backed by Wall Street money swept through foreclosure auctions in cities like Atlanta, Phoenix, and Charlotte, acquiring single-family homes by the tens of thousands. Today, institutional investors control more than a quarter of the housing stock in those key markets. They are not building communities. They are operating yield extraction operations, purchasing neighborhoods, raising rents on a fixed schedule, and wiring the profits to shareholders who have never set foot on the street. When your landlord is a hedge fund, there is no relationship. There is only a revenue target. This concentration of ownership coincided with a Federal Reserve policy that kept interest rates pinned near zero for over a decade, inflating asset prices beyond anything wage growth could match. When rates finally surged, the market did not correct. It froze. Existing homeowners with 3% mortgages refused to sell into a 7% environment, creating an inventory drought that keeps prices elevated even as affordability collapses. The market is trapped in amber, too expensive to enter, too locked in to reset. If this kind of structural breakdown is clicking into place for you, if you're starting to see how each piece feeds the next, hit subscribe and stay with this. Because what comes next transforms this from a housing problem into something that touches every dollar in your wallet. Now layer in what has happened to the American consumer outside of housing. The official inflation figures claim price stability has returned. Your grocery receipt disagrees. The Consumer Price Index is engineered to minimize visible pain through statistical techniques that would be called fraud in any private business. When the cost of steak forces you to buy ground beef, the government records that as a lateral move. Same category, no inflation. Your diet degraded, your standard of living dropped, but the spreadsheet looks clean. Meanwhile, 4 corporations control 80% of the meat processing industry, operating what amounts to a legal price-fixing cartel on food that human beings cannot choose to stop buying. The result is the widest gap between corporate profit margins and real wages since the 1940s. The consumer responded the only way available, with debt. Credit card balances have surged past $1.4 trillion, carried at an average interest rate of 23%. At that rate, debt does not shrink. It compounds. It becomes a second employer, one that takes your earnings but gives nothing back. Delinquency rates on cards and auto loans have now breached the thresholds last seen in 2008. But this is not 2008. There are no excess savings to cushion the fall. The pandemic reserves are gone. Hardship withdrawals from retirement accounts have hit record levels, which means Americans are not just spending their present, they are liquidating their future. And this is where the story turns. Because everything I have just described is the damage you can see. What is actually breaking the housing market is something most people will not discover until it is too late. The force that is silently repricing every home in America is not the interest rate. It is the insurance policy, or more precisely, the disappearance of it. Major carriers have begun what can only be described as a geographic withdrawal from risk. State Farm and Allstate have pulled coverage from entire regions of California and Florida, citing climate exposure and reconstruction costs that have outpaced every actuarial model. The financial consequences are immediate and devastating. Without insurance, a mortgage cannot be issued. Without a mortgage, a property is only worth what a cash buyer is willing to pay. And cash buyers, overwhelmingly institutional, will only bid at steep discounts, creating a forced liquidation dynamic in markets that were supposedly at peak value just months ago. For homeowners who still have coverage, the premium shock has been brutal. Bills have doubled or tripled within a single renewal cycle, adding hundreds of dollars to monthly escrow payments. In parts of Florida, insurance now costs more than the principal and interest on the loan itself, effectively doubling the price of homeownership overnight. This is a hyperinflationary event in the single largest household expense category, and it does not appear in any official inflation index. Families who locked in low mortgage rates during the pandemic, the ones who thought they were safe, are discovering that their fixed rate protection means nothing when the insurance component of their payment is uncapped and accelerating. Now extend this logic to the driveway. The average monthly payment on a new vehicle has crossed $1,000, not for a luxury car, but for a standard SUV or a work truck. Vehicle prices have climbed 30% since the pandemic, and insurance costs have surged another 26% in the past year alone. Modern bumpers are packed with sensors and cameras so expensive to recalibrate that insurers are totaling cars after minor collisions. Hey Fender Bender can eliminate your transportation entirely, pushing you back into a market charging 8% financing on an asset that depreciates the moment you drive it off the lot. Subprime auto loan defaults have reached their highest recorded level. Without a car in a country designed around the automobile, you cannot reach a job. Without the job, you lose the car. The cycle tightens. And behind all of these visible costs, the rent, the insurance, the vehicle, a quieter extraction is compounding. Corporations have discovered that the subscription model can be applied to nearly everything. Heated seats in your car require a monthly fee to activate. Software you used to purchase once now demands an annual license. Every physical product is being reimagined as a service with a recurring charge attached. The junk fee economy layers another 20 to 30% onto transactions through service charges, processing fees, and convenience surcharges that are convenient for no one except the company collecting them. Tip prompts appear on self-checkout screens for transactions involving zero human labor. Each of these extractions is individually small. Collectively, they represent a shadow inflation that no government statistic captures and no wage increase can outrun. The American consumer is not just being squeezed from above by housing and healthcare. They are being bled from below by 1,000 small cuts designed to be individually tolerable and collectively fatal. Here is where every thread we have followed converges into a single picture. And it is worse than any individual crisis suggests. The United States is not experiencing a housing correction or a temporary affordability challenge. It is undergoing a structural transformation from an ownership economy into a rental economy. And the beneficiaries of that transformation are the same institutions that engineered it. Consider the math from the perspective of someone born in 1995. Student loan debt that cannot be discharged in bankruptcy. A job market where the credential required to enter costs more than the position pays. A housing market where a median home requires an income that fewer than 40% of households earn. An insurance market that is withdrawing coverage from the places people actually live. A healthcare system where the leading cause of personal bankruptcy is a medical bill. A childcare system that costs more than in-state college tuition. Stack these costs, and you do not get a challenging economic environment. You get a generation for whom the foundational milestones of adulthood, home ownership, family formation, retirement savings, have been mathematically eliminated. The birth rate has collapsed to historic lows, not because young people do not want children, but because the economy has priced reproduction out of reach. Meanwhile, every dollar of productivity gain over the last 4 decades has flowed upward. A worker in 2026 generates 3 times the output per hour of a worker in 1970 and earns roughly the same in inflation-adjusted terms. The difference went to stock buybacks, and over $1 trillion last year, to executive compensation and to offshore structures designed to ensure it never circulates back through the real economy. The top 1% now holds more wealth than the entire middle class combined. This is the question I keep returning to, and I think it is the one that matters most. At what point does an economy that cannot provide its citizens with shelter, health care, or the ability to raise a family stop being a functioning economy and start being an extraction system with a flag? Where do you draw that line? And have we already crossed it? Tell me in the comments. The sharpest analysis on this channel consistently comes from you. The K-shaped society is now permanent. The upper arm of the K watches asset values climb. The lower arm watches debt compound. Luxury brands report record quarters while dollar stores expand into former middle-class suburbs. The middle market retailer, the commercial expression of a functioning middle class, is disappearing. And into this already fractured landscape, add the Canadian pressure. As Canada's economy contracts under its own policy failures, the outflow of capital and talent heading south intensifies competition for American housing, healthcare, and employment. Resources that are already insufficient for the people already here. This is not an immigration debate. This is a resource arithmetic problem, and the numbers do not balance. The government's response has been to issue more debt to fund the gap, pushing national interest payments past the defense budget for the first time. Every dollar created to service that obligation dilutes the purchasing power of every paycheck in the country. You are working today to retire debts incurred by people who will never face the consequences of their decisions. Inflation is not an accident. It is the transfer mechanism, the silent pipe through which wealth flows from those who earn currency to those who own assets. So where does this leave you? Not the economy in the abstract, not the policy debate, but you, sitting here, processing the arithmetic of a system that was not designed with your survival as a priority. The first honest thing to say is that the institutional version of the American dream, the one where you follow the prescribed steps and arrive at security, is no longer operational. The conditions that supported it, cheap energy, favorable demographics, accessible housing, functional healthcare, those conditions have expired. Grieving that loss is reasonable. Pretending it has not happened is dangerous. The second honest thing is that the replacement has to be self-built. No legislative package is coming to restructure the cost of housing, healthcare, and education simultaneously. The incentive structures of the people who would need to pass those laws are perfectly aligned with the system as it currently operates. Waiting for rescue is the most expensive decision you can make. What does self-built look like in practice? It starts with the savings rate, the gap between what enters your account and what leaves it. That gap is the only metric that converts into actual freedom. Geographic arbitrage, whether international or domestic, is the most powerful lever available. A remote income earned in dollars and spent in a lower-cost jurisdiction, whether that is Mexico City or Memphis, can triple your effective savings rate overnight. Millions have already made this calculation and acted on it. For those who stay, the logic shifts to local resilience. The homesteading movement is growing not out of nostalgia, but out of rational self-interest. A vegetable garden, a relationship with a local producer, a solar array on the roof. These are not lifestyle choices. They are hedges against a supply chain that has demonstrated its fragility repeatedly. A deep freezer and a water filter may offer a better real return than a savings bond in an environment where the currency itself is the risk. The skilled trades are emerging as perhaps the most strategically sound career path of this decade. Artificial intelligence is rapidly absorbing white-collar tasks, analysis, copywriting, basic programming, but it cannot replace a master electrician or a welder. These physical skills are becoming scarce precisely as demand for them intensifies, creating a blue-collar premium that inverts the old credential hierarchy. A young person entering a paid apprenticeship with zero debt may be making the most sophisticated financial decision available in 2026. And then there's the question of where you store the value you create. The fiat system, by design, requires constant expansion and constant debasement. Holding savings exclusively in dollars is not a neutral position. It is an active bet that the institutions managing the currency will prioritize your purchasing power over their own debt obligations. History offers no evidence to support that bet. Allocating a portion of your reserves to assets that exist outside the state monetary system, whether that is gold, which has survived every empire's collapse, or Bitcoin, which offers portability and resistance to seizure, is not speculation. It is diversification against a counterparty risk that grows larger with every trillion added to the national balance sheet. But the most undervalued asset in this environment is not financial at all. It is the network of people around you who possess complementary skills and shared values. A community that shares tools, childcare, knowledge, and mutual support is more resilient than any portfolio. Isolation is the most expensive luxury in an era of systemic fragility. Remember where we started. A family packing boxes in Ontario, heading toward a border and a housing market that cannot absorb them. That image is not just Canadian, it is universal. Everywhere, people are doing the math and discovering the answer does not work. The question is not whether the old model breaks. It is whether you build the new one before it does. The blueprint is not hidden. It is just not advertised. Because there is no profit in your independence. There never was.